On Friday, July the 26th, the Russian central bank took a major step by raising its interest rate by 200 basis points, bringing it up to 18%. This is the highest it's been in over 2 years. Elena Fabrichnaya, the head of the bank, has committed to further tightening measures until they see a decrease in inflation. The bank previously aimed to keep inflation at 4%, but now they've adjusted their expectations for 2024, predicting it could reach between 6.5% and 7%. Looking back over the last year, the interest rates in Russia started at 7.5%. Since then, the rates have been raised 6 times, adding up to a total increase of 10.5%, landing at the current rate of 18%. To put this into perspective, over the last 25 years, the rate has only gone above 18% once. This happened on February the 28th, 2022, right after the invasion of Ukraine, when it shot up to 20%. However, the high rate lasted only 40 days before it was lowered to 17.7%. Even though today's rate of 18% isn't considered an emergency rate, Elena Fabrichnaya has indicated that rates might keep going up until inflation is under control. When you look at other big economies in the G20, only Turkey and Argentina have higher rates at 50% and 40% respectively. Both of these countries are going through major economic crises, something we've discussed before. Besides Turkey and Argentina, the only other G20 countries with double-digit interest rates are Mexico and Brazil, but their rates are much lower than Russia's. If you compare Russia's 18% rate with the rest of the world, there are only 14 countries with higher rates. This list includes Pakistan, Angola, Zimbabwe, Liberia, Lebanon, Iran, Sierra Leone, Congo, Mali, and Nigeria, all of which are also experiencing significant economic difficulties. If we look at Russian inflation over the past year to see what's happening, we see that last June inflation in Russia was at 3.3%, which is actually below the Central Bank of Russia's target. This means things were pretty stable back then, and the central bank was likely happy with how things were going. But by July, things started to change slightly. Inflation nudged up to 4.3%, just a bit over the target of 0.3%. This small jump might seem minor, but it was a sign that prices were beginning to rise. Despite heavy sanctions against Russia because of political conflicts, the expected big spike in inflation hadn't fully hit yet. This was kind of surprising because those sanctions were supposed to make it hard for Russia to get imports, which usually makes prices go up. If we zoom out and look at the past 5 years, the picture becomes clearer, especially after big events like Russia's invasion of Ukraine. Before the invasion, inflation was under control at 9.2%, but right after, in February, it jumped to 16.7% and peaked at 17.8%. This sudden increase right after March and April 2022 makes sense because the sanctions kicked in, cutting off many usual import routes. These sanctions made everything scarcer and more expensive. Russia had to scramble to find new places to buy from, often paying more for the same stuff. This need to find new suppliers likely led to the sharp inflation spike as sellers took advantage of the higher demand and the limited supply available. The continued high interest rates showed that Russia's central bank is really trying to stabilize things and keep prices from going wild. They're raising rates to try to cool things down and prevent inflation from getting out of control. However, what happened between April 2022 and April 2023 in Russia is pretty interesting and a bit confusing. Inflation, which is basically how much prices rise over time, started dropping. By February 2023, it was down to 11%. Then it fell even more, hitting 3.5% in March and dropping further to 2.3% in April. At that point, Russia has one of the lowest inflation rates in the world, which was quite an achievement. Now, if you look at what's going on with interest rates during the same year, things get even more puzzling. Interest rates went down from 17.7% to 7.5%. Usually, to tackle high inflation, a country raises its interest rates. Higher rates make borrowing more expensive, which tends to slow down spending and in turn slow down price increases. But Russia was doing the opposite. They were cutting rates while inflation was also falling. This situation is strange because it goes against what you'd typically expect. It gets even more shocking when you consider the last 12 months. Inflation has been climbing back up, reaching 8.6%. During this time, interest rates have also been rising, going from 7.5% to 18%. This recent change makes more sense because raising rates can help control rising inflation. But the earlier drop in both inflation and interest rates at the same time is something that's not so easy to understand. Let's break down the inflation trends we've seen over the last few years. From April 2020 to April 2023, there was a noticeable decrease in both interest rates and inflation levels. However, there are some doubts about the accuracy of the inflation figures reported during this time. Moving to the past year, we've observed a sharp increase in inflation and interest rates, which makes sense when you consider the Russian economy's current challenges, such as international sanctions and workforce shortages. One important aspect to look at is food inflation, which is a crucial indicator of how the economy impacts the less well-off members of society. In June 2023, the increase in food prices was incredibly low at only 0.2%. However, over the last year, there has been a consistent and significant rise in the cost of food. By June 2024, the increase reached 9.8%, which is higher than the overall inflation rate of 1.2%. This fast rise in food prices compared to general inflation is particularly tough on poorer individuals who tend to spend a larger share of their monthly income on food. With food costs rising by nearly 10%, it's critical that their earnings also increase at least by the same rate to keep up with these costs. The disparity between the rise in food prices and general inflation highlights the extra financial pressure on those with limited income. It's essential to keep an eye on these figures because they tell us a lot about the economic challenges faced by everyday people. Over the past 12 months, there's been a notable increase in real wages in Russia. Real wages are essentially what people earn after accounting for the rate of inflation. This means if inflation increases by a certain percentage, but your wage increase outpaces that, your purchasing power improves. For instance, if inflation was at 8.3% and wages increased by 8.8% as they did in May 2024, it effectively means that wages rose by more than the inflation rate. This would be a real increase of about 0.5%. This means that despite the prices going up due to inflation, people are earning enough extra money to not only cover these higher costs, but also have a little more left over than before. This positive change is good news for workers because it means they're getting more money compared to the rise in prices, so they can afford to buy more or save more than they could previously. However, this situation also adds a layer of complexity to the economy. When wages increase faster than inflation, it can put pressure on employers to keep rising salaries to attract and maintain their workforce. This can lead to higher prices for goods and services as businesses try to cover their increased labor costs. Thus, while the workers are benefiting from higher real wages, it also creates challenges for the overall economy, which needs to balance rising wages with the risk of escalating prices further. Now let's look at what's happening with producer prices in Russia as they provide a clear insight into potential inflation trends in the near future. Producer prices, often called factory gate prices, are the cost of goods as they leave the factory and head to stores. In June 2023, these prices were stable and showed no increase. However, over the past year, there has been a noticeable rise. In June 2024, producer prices had increased significantly by 14%, which is about 6% higher than the current inflation rate. This indicates that the cost of goods made in Russia and then sold to businesses or retail outlets is rising faster than the prices consumers see in stores. This trend suggests that we can expect consumer prices to continue to rise as well. When goods become more expensive at the production level, retailers typically add a markup to cover the increased costs, which means the final prices that consumers see is likely to go up. Besides the rising producer prices, other factors are also driving inflation. For example, the cost of importing goods into Russia has increased substantially over the past 2 years due to sanctions. These sanctions have limited where Russia can buy its imports from, reducing competition and driving prices up. Changes in the value of the Russian ruble have also played a role in affecting overall prices. Over the last 5 years, the value of the Russian ruble compared to the US dollar has seen significant changes, which is a topic of interest for many. The value of the country's currency often reflects its economic health. Normally, if a country's economy is strong and other countries buy a lot of its products, its currency will be high in demand. This demand increases the value of the currency based on the simple principle of supply and demand. However, the opposite is also true. If a country isn't seen as a good trading partner and there isn't much demand for its currency, its value tends to drop. This was the case with Russia around the time of the Ukraine invasion. Before the invasion, one US dollar was equivalent to about 75 Russian rubles. After the invasion, due to anticipated international sanctions that would likely reduce Russia's trade with other countries, the ruble's value fell drastically. At one point, the exchange rate went so low that $1 was worth about 150 rubles. These fluctuations are significant because they affect Russia's ability to engage in international trade and influence how its economic stability is viewed by the rest of the world. After a significant drop in the value of the Russian ruble due to geopolitical tensions and sanctions, there was a brief period of recovery thanks to efforts by the Russian central bank. The bank bought a large amount of rubles on the international market, which briefly increased its value to around 50 rubles per US dollar, the strongest it has been in a while. However, this improvement didn't last. Over the past 2 years, the value of the ruble has fallen again. This decline was partly due to the central bank stopping its purchase of the ruble, which had become too expensive to maintain. More importantly, the demand for the ruble decreased significantly. Western countries, which had previously traded with Russia, reduced or stopped their transactions, reducing the need for the ruble. Russia's new trading partners, China and India, also decided not to use the ruble for their transactions. China opted to trade in its own currency, the yuan, and India, after initially considering its own currency, followed suit by choosing the yuan and the United Arab Emirates dirhams for trade. This lack of demand caused the ruble's value to drop, reaching as low as 100 rubles per US dollar at one point. In response, President Putin introduced strict measures requiring Russian companies to conduct their transactions in rubles, which helped to stabilize and slightly improve its value. Over the last 7 to 8 months, these efforts have led to some recovery, with the ruble now trading at around 85 to 1 US dollar. Despite these recent improvements, the market for the ruble remains quite small. It's mostly limited to countries like Venezuela and Cuba, or others where Russia has significant trading influence and where there are few other options. This situation shows that while the ruble's value has seen some recovery, it does not necessarily reflect an improvement in the overall strength of the Russian economy.